Patricia died on a Tuesday in March. She was 71 years old. She had spent her entire adult life being careful with money. She owned a paid-off home in Hamilton worth $780,000. She had an RRSP with $340,000 inside it, a TFSA with $95,000, a non-registered investment account with $62,000. Total estate, $1,277,000. Her daughter Sarah assumed she was inheriting roughly $1 million. She had already started thinking about what she would do with it. 3 months later, Sarah received a letter from a tax lawyer. The CRA was presenting a tax bill against her mother's estate, $127,400. Not because Patricia did anything wrong, not because she hid income or evaded taxes or made bad decisions, simply because nobody, not her bank, not her financial advisor, not her accountant, had ever sat her down and explained what the CRA does to your money the moment you die. The RRSP alone triggered $136,000 in taxable income on Patricia's final tax return. Her non-registered account added another $18,000 in deemed capital gains. The estate spent 8 months in probate. The lawyer's fees consumed another $19,000. Sarah inherited $1,110,000 instead of $1,277,000. She lost $167,000. Not to bad investments, not to market crashes, to a lack of planning that would have taken Patricia one afternoon to fix. Today we make sure that never happens to your family. Here's what we're covering. Chapter 1. What actually happens the moment you die in Canada? The CRA's rules, the deemed disposition, and why your final tax return is often the biggest one you ever file. Chapter 2. The RRSP and RRIF death trap. Why the account your bank sold you as a retirement miracle can hand the CRA a 6-figure bill the day you pass, and the one beneficiary designation that changes everything. Chapter 3. What happens to your TFSA? The good news and the hidden deadline most families miss. Chapter 4. The Principal Residence Exemption. Why your home is probably tax-free, but the paperwork still matters more than most people realize. Chapter 5. Probate. What it is, which provinces charge the most, and the simple steps that legally bypass it entirely. And Chapter 6, the one I've been building toward, the complete estate protection checklist. The exact steps Patricia should have taken and that you can take this week to protect your family from a tax bill they never saw coming. I'm Grace from Money Glow Up. This is education, not financial advice. Please speak with an estate lawyer and a tax professional before making any decisions about your estate. This is important stuff. Let's get into it. Most Canadians assume that when you die, your assets simply pass to your family. Your kids get the house, your spouse gets the savings. Everyone moves on. That is not how the CRA sees it. The moment you die, the CRA treats you as if you sold every single asset you owned, at fair market value, on the day of your death. This is called the deemed disposition rule. You didn't actually sell anything, but for tax purposes, the CRA calculates the capital gain on every asset as if you did. Your stocks, your investment properties, your non-registered ETFs, your cottage. Every asset that has grown in value since you bought it. The CRA calculates the gain and adds it to your final tax return. And your final tax return, called the terminal return, is filed by your estate. It covers January 1st of the year you died through the date of death. It includes your regular income for that year, plus every deemed capital gain from the deemed disposition. For many Canadians, this is the single largest tax return they ever file. And it has to be paid, in cash, by the estate before anything is distributed to the beneficiaries. Now here's what makes this genuinely dangerous. The deemed disposition applies to growth in value. If you bought a stock for $10,000 and it's worth $60,000 when you die, That's a $50,000 capital gain. Under current rules, 50% of that, $25,000, gets added to your terminal return income. At a 40% marginal rate, that's $10,000 in tax on one stock. Multiply that across a lifetime of investments, and you begin to understand why Patricia's estate owed $127,400. Now, two important exceptions. Exception 1, the spousal rollover. If you leave assets to your spouse or common law partner, the deemed disposition is deferred. Assets roll over to the surviving spouse at cost, no tax triggered at death. The tax is simply postponed until the surviving spouse eventually sells the assets or passes away themselves. This is the single most powerful estate planning tool most married Canadians already have access to and never think about. Exception 2, registered accounts with named beneficiaries. We'll cover this in detail in chapters 2 and 3. But the short version, if you name the right beneficiary on your registered accounts, the deemed disposition rules work very differently. This is the chapter that is going to change how you think about your RRSP. When you die, the full value of your RRSP or RRIF is added to your income in the year of death. Not 50% of it like capital gains. Not a portion of it. All of it. Every single dollar is treated as income on your terminal return. Patricia had $340,000 in her RRSP. That $340,000 was added to her income on her final tax return. Her marginal rate on those dollars, 40%. Tax bill, $136,000. The RRSP that was supposed to fund her retirement became the CRA's single biggest claim against her estate. Now here is where it gets critical, and where the right planning makes an enormous difference. The named beneficiary changes everything. If you name your spouse or common law partner as the beneficiary of your RRSP, the entire account rolls over to their RRSP tax-free at death. No tax triggered, no terminal return income. The full $340,000 transfers to your spouse's RRSP intact. The tax is deferred until they withdraw it, hopefully in lower income retirement years. If you name a financially dependent child or grandchild as the beneficiary, there are also special rollover rules that can reduce the tax hit significantly. If you name your estate as the beneficiary, or leave the beneficiary field blank, the full RRSP value hits your terminal return as income with zero deferral. The estate pays the tax before anything reaches your family. This is Patricia's mistake. Her RRSP beneficiary was listed as her estate, not her daughter. Her estate. One field, left blank or incorrectly filled. $136,000 in preventable tax. Here is your action item from this chapter. Log into wherever your RRSP is held, right now, today, and check who is listed as your beneficiary. If it says estate, or if it's blank, change it. Call your financial institution. Ask for the beneficiary designation form. Fill it out. This takes 20 minutes and could save your family 6 figures. Good news first. The TFSA is the most death-friendly account in Canada. If you name your spouse or common law partner as the successor holder of your TFSA, not just the beneficiary, the successor holder, your TFSA transfers to them completely intact. It keeps its tax-free status. It keeps growing. No tax, no probate, no terminal return inclusion. It simply becomes their TFSA. This is different from naming them a beneficiary. A successor holder assumes ownership of the account. A beneficiary receives the value of the account, which may have different tax and timing implications depending on when the funds are distributed. For non-spouse beneficiaries, your children, for example, the TFSA is still tax-free up to the date of death. Any growth that occurs inside the TFSA after the date of death, but before the funds are distributed, becomes taxable income for the beneficiary. This is the hidden deadline most families miss. The longer probate takes, the longer the estate is being processed, the more post-death growth accumulates inside the TFSA and becomes taxable. The solution is to distribute TFSA proceeds to beneficiaries as quickly as possible after death. There is also a little-known planning opportunity. If you have unused TFSA contribution room, a lump sum can be contributed to maximize the tax-free shelter before significant health events. Some Canadians contribute their maximum room in the year they are diagnosed with a serious illness specifically to maximize what passes tax-free. Patricia's $95,000 TFSA, because she named Sarah as a direct beneficiary, passed entirely tax-free. This was the one thing done right. It transferred quickly. No tax, no probate inclusion in most provinces. The lesson: the TFSA is powerful in death. But the successor holder designation matters enormously for spouses, and speed of distribution matters for everyone else. Here's the one piece of genuinely good news for most Canadian families. Your principal residence, the home you live in, is exempt from capital gains tax when it's sold or deemed sold at death. The principal residence exemption is one of the most valuable tax shelters in Canada, and most homeowners benefit from it without ever thinking about it. Patricia's home in Hamilton was worth $780,000. She bought it in 1989 for $190,000. That's a $590,000 capital gain. Under the principal residence exemption, zero tax. The full $780,000 passed to her estate with no capital gain triggered. But here's where it gets complicated. Complication 1. The paperwork still matters. Since 2016, the CRA requires you to report the sale or deemed disposition of your principal residence on your tax return, even if the gain is fully exempt. If this isn't reported on the terminal return, the CRA can deny the exemption entirely. Your estate executor needs to know this. Your tax preparer needs to know this. Complication 2. Multiple properties. You can only designate one property per year as your principal residence. If you own a cottage and a home, only one gets the full exemption. The other is subject to capital gains on death. Many Canadians with cottages that have appreciated significantly face very large capital gains bills on the cottage at death, often at the worst possible time for the family. Complication 3. The rental property. If you converted your home to a rental property at any point, even partially, the exemption gets complicated. The years it was used as a rental do not qualify for the exemption. The CRA calculates a prorated gain for the rental years. For most Canadians with a single home, they've lived in their entire ownership period. The principal residence exemption is clean, simple, and enormously valuable. Just make sure your executor files it correctly. Probate is the legal process of validating your will and giving your executor the authority to distribute your estate. And in Canada, it comes with a fee, called probate fees or estate administration tax, that varies dramatically by province. In Ontario, probate fees are approximately 1.5% of the estate value above $50,000. On a $1,277,000 estate like Patricia's, that's roughly $18,400. In British Columbia, the fee is similar, about 1.4% on amounts over $50,000. In Alberta, probate fees are capped at $525, regardless of estate size. One of the most estate-friendly provinces in the country. Quebec doesn't have probate fees for notarial wills. Another reason Quebec's civil law system handles estates differently. Now here's the important part. Probate fees are not inevitable. There are completely legal ways to reduce or eliminate them. Method 1. Name direct beneficiaries on all registered accounts. RRSP, RRIF, TFSA, and life insurance policies with named beneficiaries bypass the estate entirely. They transfer directly to the beneficiary. They never go through probate. They are never subject to probate fees. Patricia's TFSA bypassed probate because Sarah was named directly. The RRSP went through the estate because it was unnamed. The probate fee on the RRSP value alone was significant. Method 2. Joint ownership with right of survivorship. Assets held jointly, a home, a bank account, automatically transfer to the surviving joint owner at death. No probate, no fees, no delays. Many Canadian couples hold their home in joint ownership precisely for this reason. The home transfers instantly to the surviving spouse without touching the estate. Method 3. An inter vivos trust. A living trust transfers assets to a trust during your lifetime. The trust, not your estate, owns the assets at death. They never go through probate. This is more complex and has costs to set up, but for large estates, it can save tens of thousands. The core lesson: every asset that passes through your estate is subject to probate fees and delays. Every asset that bypasses your estate through named beneficiaries, joint ownership, or trusts is not. Okay, let's make this actionable. Here is exactly what Patricia should have done, and what you can do this week. Action 1. Update every beneficiary designation. Log into every registered account you own: RRSP, RRIF, TFSA. Pension, life insurance. Check the beneficiary field on every single one. For your RRSP and RRIF, name your spouse as the direct beneficiary for the spousal rollover. If you have no spouse, name your children directly, not your estate. For your TFSA, if you have a spouse, name them as the successor holder, not just the beneficiary. This preserves the tax-free status of the account completely. For life insurance, name your beneficiaries directly. Never name your estate unless there is a specific reason to do so. This one action alone, updating beneficiary designations, could save your family $50,000 to $150,000, depending on your account sizes. Action 2. Write or update your will. 45% of Canadians have no will. If you die without a will, called dying intestate, the province decides how your assets are distributed according to a fixed formula that may bear no resemblance to your wishes. The courts appoint an administrator. The process is slower and more expensive. Family disputes become more likely. A basic will cost $300 to $500 with a lawyer. An online will service like Willful or Epilogue costs $100 to $200. There is no acceptable reason to die without one. Action 3. Consider joint ownership on your home. If you are married or in a common law relationship and your home is only in one person's name, talk to a real estate lawyer about adding your spouse to the title as a joint tenant with right of survivorship. The home then transfers automatically at death, bypassing probate entirely. Note, this is a legal change with implications. Do it properly with professional guidance. Action 4. Plan for the cottage. If you own a cottage, vacation property, or investment property that has appreciated significantly, talk to a tax professional about your options, now rather than leaving the capital gains bill for your estate. Options include transferring the property during your lifetime, selling it, and investing the proceeds inside a TFSA, or purchasing life insurance specifically sized to cover the anticipated capital gains bill at death. Action 5. Tell your executor where everything is. A surprising number of estates lose money simply because the executor cannot find the accounts, the passwords, the insurance policies, or the beneficiary designations. Keep a secure document, physical or encrypted digital, that lists every account, every institution, every policy, and every beneficiary designation. Update it annually. Tell your executor where it is. Action 6. Get professional help. An estate lawyer and a tax accountant who specializes in terminal returns are not luxuries. For an estate of any meaningful size, they are the difference between your family inheriting what you built and your family paying a bill they never expected. Patricia's $19,000 in lawyer fees after death would have been $2,000 in planning fees before it. The ratio is never in favor of waiting. Here's the truth nobody wants to say out loud. Estate planning is not about death. It is about the people you love and the life you spent building something for them. The CRA does not care about your family. The probate process does not care about your family. The institutions holding your money do not remind you to update your beneficiary designations. You have to care, and you have to act. Patricia built $1,277,000 over a lifetime of careful decisions. She lost $167,000 of it in 3 months of paperwork and tax bills that a single afternoon of planning would have prevented. The checklist is not complicated. The forms are not complicated. The conversations with your spouse, your children, your executor, your lawyer are not complicated. What is complicated is watching your family navigate an estate in grief while also managing a 6-figure tax bill that was never supposed to exist. Do the planning. This week, not next year. I'm Grace. This is Money Glow Up, and I'll see you in the next one.